The Social Security retirement benefit system, say that 3 times fast, the goal is not to make people rich, right? We don't want Social Security millionaires. Hey everybody, this is Christopher with Centennial Advisors. Today I want to share with you as succinctly as possible everything that you might want to know to help make the most informed decision possible with regard to your Social Security retirement benefits. Let's talk about your eligibility for benefits. To become eligible for Social Security retirement benefits, you're going to need at least 40 credits of service with an institution that pays FICA taxes, that pays into the Social Security system. For example, most public schools and some public institutions do not pay into Social Security because they have their own defined benefit or other types of pension plans. If you work for a private company, meaning not for the government, there's a very high chance that you do pay into the Social Security system. And the way that the Social Security Administration defines a credit is any year in which you made at least $1,730. You can receive up to 4 credits in any one year. The Social Security Administration dictates that as long as you made at least $1,730 in that given year, you've earned a credit. And with a maximum of 4 credits, that means that if you worked for only one day out of the year and you made $6,920, you would have made 4 credits for that year. But for most people, it requires about 10 years for you to be fully paid into or eligible for Social Security retirement benefits. Working for 10 years, though, doesn't dictate on its own how much you're going to receive in benefits. Generally speaking, the more you make, the more you pay taxes, and the more you're going to get out of your Social Security retirement benefits. There's a couple caveats to this. They use the highest 35 years of inflation-adjusted earnings in determining your benefit. If you don't have 35 years, they're going to plug in zeros until they get to 35 years, so that could reduce your benefit. And if you're looking at a benefits estimate, they're going to typically assume that you keep working for the next couple of years, earning a similar wage to what you have been for the past couple of years. So it's important to read the fine text on those benefit summaries. The Social Security retirement benefit system, say that 3 times fast, the goal is not to make people rich, right? We don't want Social Security millionaires. And so as such, they use a wage-weighted system in determining your benefits. In practice, what that looks like, and to put it into plain English, is that the first couple dollars you make are going to be very important in determining your benefit, and then each additional dollar that you make counts less and less towards that benefit. This also serves to equalize the playing field a little bit. It doesn't take that much earnings to basically get the majority of the benefit that you're entitled to. Let's talk a little bit about Social Security timing. You can choose when you want to take your retirement benefits. You can take them as early as age 62 and as late as age 70. On your Social Security benefit statement, they're going to give you what's called a PIA, primary insurance amount. And this is the dollar amount of benefits that you would be eligible for if you took Social Security at your full retirement age, which, if you were born in or after 1960, is age 67. From here, this PIA gets adjusted either up or down, depending on if you take benefits late or early. If you take benefits early, your PIA gets adjusted 0.05% down for every month that you take it early. Now, if you defer benefits and you take them later, your benefit gets adjusted upwards 0.08% per month, again up to a maximum at age 70. Because you have a lot of freedom in determining when you want to take your Social Security benefits, there's a lot of clever planning that you can do to make sure that you maximize the amount that you're getting out of the Social Security retirement system. One other common strategy that I see to maximize your Social Security benefits is to have the lower earning spouse take their benefits first. Because the higher earning spouse, you don't want to adjust their income down, their Social Security benefit. You want to get the most out of that you can. So if you can survive off the lower earning spouse's benefit for as long as possible, while deferring the higher earning spouse's benefit, then once the higher earning spouse starts taking their benefits, the lower earning spouse becomes eligible for the spousal top-up. The spousal top-up happens automatically. You don't need to file for it or anything. But one thing that I will caution you about is that this strategy does require a little bit of planning, and you want to make sure that you do it right, because in most cases, once you file for Social Security benefits, you cannot rescind it. So make sure that you're talking with your advisor or your Social Security expert to make sure that your plan is solid and that you know and understand how it works. One really common question that I get is about the taxability of Social Security benefits. The IRS has come up with I don't know if it's special, but it's a separate calculation in determining how much of your benefit is taxable. And it's based on a field that they call your provisional income. And the only time that this field is ever used is in determining the taxability of your benefits. I'm not a CPA, so I would definitely consult one before making any decisions based off of this information. But your provisional income is your adjusted gross income plus half of your Social Security benefit. Now, based on how much provisional income you have determines how much of your Social Security benefit is taxed as ordinary income. So it gets a little confusing. It kind of feels like a recursive calculation. So again, consult a CPA to be sure. And the last question that I get all the time about Social Security benefits is, what if I'm still working and I opt to take my benefits? The short answer is, if you are above or at full retirement age, then it doesn't matter. You can work as much as you want. The other answer is that if you're working and you make no more than $22,400 per year, it also doesn't matter. It will have no effect on your benefits. However, if you're under full retirement age and you're making more than that threshold, your benefits are going to be reduced. The Social Security Administration has a calculation that they do to determine how much your benefit gets reduced by, and here's a little chart that you can consult to hopefully make that a little bit easier. Now, hopefully by this point, you feel like a Social Security expert and you're ready to go conquer the SSA and maximize benefits for you and your family. However, if you're still feeling a little bit shaky or that this stuff is too complicated for taste, give us a call. We're happy to walk you through it. Happy to schedule a free consultation to make sure that you and your family are getting the most out of your retirement benefits. Thank you for watching Centennial Advisors on YouTube. Again, my name is Christopher, and I hope you have a wonderful day.